Hello, welcome to this week's episode of the Realtors. I'm David Blair. He's Trevin Perez. How's it going, Trevin?
Hey man, fantastic. How are you today?
I'm good. I'm good. So we talked about several things this last week. One of the things we focused on was that it is kind of a down time period in our market right now. Would you agree with the holidays?
It is, and it made for a great time for us to start doing these new series that you're going to speak on.
Exactly. So what we wanted to do is we wanted to put together a series over the next few weeks where we're going to talk to industry experts. We're going to talk to cover mortgage, home inspection. What else are we going to cover?
We're going to cover appraisals. We're going to also cover real estate coaching and coaches out there.
Exactly. So the main focus over the next few weeks is getting people ready, getting buyers ready to go back into the market. We've had a lot of talk through the election where people were sitting on the sideline. Maybe they're sitting on the sideline because of rates or wanting those to adjust again. So the hope here is to educate our viewer audience in letting them know what the process is to buying a home. So we're going to start off today. We're lucky to have Eddie O'Keefe. Eddie is with SWBC Mortgage. He's been in the mortgage industry for 28 years. His company's been around since 1988, and they're actually active in over 40 states nationwide. So without further ado, we'll welcome Eddie O'Keefe. Eddie, welcome to the show.
Thank you, and pleasure to be here. Thank you for the invite, Blair and Trevin. Ready to
Definitely.
get excited and talk mortgage.
Yeah, we. I was telling Trevin. I was telling you. So Eddie is. Eddie's a funny guy. He's really good at what he does from a local standpoint with mortgages. He puts out a lot of content on Instagram. I started following him a while back, and I said this is someone I think that we need to share with our viewers and get his take and give us some good information on the mortgage industry.
Yeah,
Yeah,
I'm
thank you,
excited. Welcome, Eddie.
thank you. Appreciate it.
So tell us, we'll give you an opportunity to speak for a minute. Give us a little bio, anything. I kind of covered some of the basics, but just kind of introduce yourself and tell us who you are, what you do.
Sure. So Eddie O'Keefe, SWBC Mortgage. I've been with the company, 28 years, 13 years with SWBC. SWBC is a full-fledged lender, which means most of the products that we close under, we keep in-house, meaning that we service that loan too. So the benefit with company SWBC is that you get me not only with your home purchase, but you get me throughout the life of your loan. That if you have questions come up and things of that nature, it's a benefit. We don't sell that mortgage off, so you get to come back to me. Of course, we do have other types of mortgages out there that we do, close under SJBC, and then they are sold off afterwards. They're more like the specialty programs and some of the down payment assistance programs, and we'll talk about those here in a moment. Um, the good thing about us is that we're also not a huge company. You're not a number. You're a client, so we can maneuver and take care of you if you need to close quickly. You know, you've got some things that you need to work on with maybe credit. We get you in our pipeline, that we can help you walk you through. So even I don't like to say no to a client. I just like
Mhm.
to say not today, and then we put a plan to get you to home for the future.
Nice. Hey, let me ask you real quick. How common is it, Eddie, that your company actually services the loans as well? Because I go to a lot of closings, and during the closing, 90% of the time, it seems like the title rep is there, and they're saying, "Oh, and here's this document. By the way, your mortgage has already been sold," before they ever even sign paperwork or make that first payment. So is that pretty rare?
I wouldn't say it's rare, but it's not very common. I would say that of the mortgage folks that you're going to close with out there, I would say it's probably about 25-30% of the lenders are lenders that will actually hold their mortgages.
Okay.
Well,
Okay. So what? So take us through this scenario. So we get a call on, let's say, a listing or a property that a buyer's interested in. What should that first phone call look like? Because I get calls a lot of times, and a customer says, I want to go out and I want to see XYZ property. that you've listed. And one of the first things we ask usually is, okay, are you currently working with any other agents? Are you working with a lender? And a lot of times, surprisingly, we get, well, no, I haven't called anyone yet regarding a mortgage. I want to see what's out there first, and then I want to wait and go through. So how early should they actually contact you in that regard?
If you're thinking about buying a house, I would say within the next 6 months is to contact a lender. Obviously, if you just saw one on Zillow and you fell in love with it and you call Trevin or Blair to go take a peek at it and you want to do a mortgage, things go fairly quickly there. But I'd recommend folks, if you're looking to buy in the next 6 months, is to go ahead and get yourself financially ready. And what I mean by that, this is the pre-approval is the same, whether you call me 6 months, ahead of time, or you're going to call me the day that you see a property and want to make an offer on it. That phone call is going to look something like this. We're going to get some details from you. Mostly it's financial details. We'll get like names, social security numbers. We're going to get a 2-year job history, a two-year residence history, what kind of assets you have, maybe any external debts, child support, other things that are not related to a credit report. After we get this information, we're also going to ask you questions like, what's your goal? What's your house payment? What's the max paying for your house payment? How much do you have to work with for a house? Details that can specify a loan program, like, are you a veteran? Are you looking to buy, outside of city limits? And I'll explain why here in a moment. So we kind of get those details up front. And then the work starts on my end. I'm going to take those details. We're going to run a credit report. We're going to look at your scores. We're going to look at your debt to income ratios. How much money you've got to work with for a loan, and then we're going to tailor a loan or a couple options for you to buy that house. In the whole time, what we're doing is we're putting you in a place that's going to meet your needs. You want to keep to a certain payment. Use a certain amount down. So there's a lot of ins and outs. It's not a very 5-minute process. We like to take the time to make sure that what we put you into is something that's going to benefit you for the long run. And then let's say if you aren't qualified at the moment, or there's things you need to work on, then we can put a plan together. Maybe you need to boost your score up a little bit. Maybe you need to save a little bit more money down. You need a little bit more time on the job, whatever the case may be. We put you in a plan. So when if it is 6 months out or more that you want to buy, but when that time comes, then you're ready, versus calling right when you see a house and then find out that there's some things you have to work on and it's going to prolong your buying, or you have to re-sign a lease for another year or something of that nature. So sooner is better when it comes time to buy a home. Plus, you also will know what you're comfortable with payment-wise and the price point that you can shop in. There's nothing worse to go see a house that you don't qualify for and you have to back up. So you want to make sure you know what you're qualified for moving forward.
Yeah, definitely. See, did I tell you this guy was good, Trevin? Did I tell you?
He's sharp. He's on the money.
What questions do you have, Trevin?
Well, let me ask you, Eddie. What are the current interest rates? What are your fees? We see what bank rate, and we hear a lot about the Feds and basis point cuts. How does all of that work, and how does that affect the end customer? Give us a big picture of that.
Sure. Let's talk about the fees first. When you're looking at a mortgage, there's typically 1 or 2 fees only that's going to be different from every other company. And that's called an origination fee, or your lender fee, or any points that you're paying, any discount points for that interest rate, like a buy down. And we'll come back to the buy down here in a moment. But that fee, that lender fee, that's what's going to be different. All the other fees you see on that sheet are going to be title, appraisal, deed stamps, recording fees. It doesn't matter what lender you use. All those are going to be the same because they're going to be dictated throughout the transaction, like who the title company is and so forth. So the lender fee is going to be the most important. We have a one fee. It's $11.95. We don't charge extra processing and doc prep fees and so on and so forth. Tax service fees. You're going to see a lot of that stuff. Sometimes the lenders will break it down. It's always going to be in the very top of the estimate. That top of the estimate is the lender's portion. That's the first place to look at it. So 11.95 is our fee, and that's for all programs. So no matter what program you do, you're going to get charged 11.95 from us as a lender. The second part of that fee is it's called discount points. And discount points, which is very common in today's market where rates are currently, is maybe getting seller credits to buy that rate down to make that payment more comfortable, or maybe there's a fee in there for what's called a 2-1 buy down. And we could talk about that here in a moment, but that's the two things to look at as far as fees if you're shopping lenders. Now, rates are another important thing, but the lowest rate may not be the best deal. And that relates to the discount point. So let's say if I quote you an average rate, we're going to do a range in this market because the rate's going to be based on the program. It's going to be based on the credit score, how much you're putting down. If you're putting down a good chunk of change, 20, 25% or more down, you are going to get a better deal. You're going to get a better rate. If you're putting minimum 3% down, you're going to pay a little bit higher interest rate. So that range of say high 6s to low 7s is going to be your average rate. Now, I can quote you say, just for an example, a 7% rate. And then you look on your fees and you just see my 11.95 and no discount points. That means I quoted you what's called a par rate. There's no cost for that rate. You could get an estimate from another lender showing 6.5. You're like, oh my God, this guy's half point lower. I got to go with him. Without looking at that lender fee, those discount points, it could be $10,000. So you're paying $10,000 to get that rate. So it's key to look not only at the rate, but look at the cost that the lender is charging you, which is the lender fees and the discount points.
Fascinating, fascinating. So marry the house, not the rate.
That's right. Exactly. The important thing when you're buying a house is you want to come up with a combination of what you can comfortably spend each month as a payment on top of what you can comfortably come off or come out of pocket with. So you may love the rate of 6.5, but you may not like the costs or may not have the means for that cost to get that rate of 6.5. So it's kind of getting that happy medium, working within it. Now, to both your points about the market being a little bit slower this time of the year, that's a great opportunity for buyers because you have sellers who are willing to negotiate. And what's been popular in these time frames is that the sellers are willing to give seller credits, which we take those seller credits, and that's where we're doing these buy downs. So we're either buying down the rate permanently. Let's say the rate's 7, I can buy it down to 6.5 or 6%. That rate's going to be set for the 30 years. Or we do these what they call 2-1 buy downs, and it's still a fixed rate. It's not an adjustable rate. But let's say that rate starts at 7, and we do a 2-1 buy down. That first year, that rate's going to be 5%. So your payment is going to be figured off a 5% rate. The second year is going to be figured off a 6% rate. And then the third year on, a 7% rate or more. The idea with the 2-1 buy downs is that, get a little bit cheaper payment now, wait for rates to come down in the future, and then refinance it into a lower permanent rate. So you have those options. And with markets that we're currently in, these options are available. If things were to heat up, it becomes more of a seller's market. Sellers are unwilling to come off the closing costs or, concessions. It becomes more difficult to negotiate these type of terms. So this is a market that's actually beneficial to a buyer.
Yeah, it's a good
Makes
point. I
sense.
saw some of your content you posted the other day in that regard, and I do agree with that as well. That if the buyers would look at big picture and understand that okay, right now there's not a lot of buyers in the market, but there's still really not a lot of inventory. We're not dealing with a surplus of inventory depending on the area. So if you're waiting, a lot of times you're waiting until we've talked about this on previous shows. If you're the only person at the table, then you've got that seller's undivided attention. Whereas if you wait 30, 60 days, we get into that spring market, rates are a little bit lower, maybe a little more attractive. Well, now all of a sudden you're paying a lot more for that property than what you would
Right.
have in the current market now, and could end up paying more,
Right.
overall.
Yeah.
So
Let me ask a
it's a
question,
good.
though, a follow-up question on where you were just going. How does all of this go back to the Fed rate and the fact that they just dropped 25 basis point after the last 50 basis points. And I know we're expecting in December him to, Jerome Powell to drop again, potentially another 25 basis point. But the real question is, when does all of this trickle down to the average consumer?
Sure. So the Fed's funds rate is an overnight rate, short-term rate. And although it sometimes runs parallel with long-term rates, which would be your mortgage rates, it doesn't always. So the Fed's funds rates, when they drop that Fed's funds rates, it may not necessarily mean that the interest rates from a mortgage are going to drop. The mortgage rates look, again, long-term. Fed's funds look short-term. Fed's funds rates looking to boost the economy, keep it from going into a recession, alleviate pain for corporations, and not only corporations, but for consumers. The rates that drop when they drop that funds rate that see immediate impact are like your credit cards, home equity line of credits, car loans, things of that nature are going to see an immediate, within 30 days. So Feds drop a quarter within 30 days, these rates have dropped as well. 30 to 60 days, these rates have dropped as well. The mortgage rates, or the long-term rates, look at additional factors. So they are looking at, the biggest one is inflation. Inflation is going to be the biggest driver when it comes to long-term rates, because as inflation goes up, becomes more expensive for your everyday household items and so forth. What they want to do is avoid that. So keeping the rates higher means there's going to be less production. People spend less. They bring that inflation down in a check. Now, we saw a good drop in rates before the half point cut back in September. The market was forward thinking. And so the rates, they say, averages in around 7% right before that cut, get down to almost 5. I mean, actually, there was a few, if you're putting a big chunk down, you were in the 5s. It was very short-lived, though. As soon as that cut happened, then we had reports come out with the CPI, Consumer Price Index, and the PPI, the Producer Price Index, which follow inflation, came out a little bit hotter than expected, meaning that inflation isn't quite where it needs to be. Rates shot back up. You had also the election uncertainty. And with an election, there's two sides of the coin. That you have Trump, who is more pro-growth, and with that growth is a chance of inflation. With selling oil and all this stuff that he plans on doing, there is a chance for inflation with that. Versus Kamala is more, not as growth ridden, so the markets react differently when who was coming in the office. Now, the Feds just reduced a quarter a few weeks ago. The rates didn't change whatsoever. They're anticipating to do another quarter bump in December, but the thing about the rates is that, remember, they're always forward looking. Jerome Powell's comments of, we have to reevaluate future rate cuts, is the reason why rates are staying steady where they're at. If he had come back and said, we're going to be on track for 4 rate cuts again in 2025, we probably would have seen a pullback, because the markets are reacting to what's going to happen in the future. So I don't think, as far as rates are concerned, we're probably going to be in this range at least until January, or at least until February when he does that, or excuse me, December when he does that next cut, and then comes out and talks about his guidance for the 2025 session. So we probably got a month or two before we see any movement either way. We're going to kind of just float in this range, so to speak.
Damn, that's fascinating.
It's
Dave,
good stuff.
here was this kind of insight for us when we're talking about interest rates. Jesus.
My breakdown is simply just lower the interest rate. I don't care how you do it. Just lower the interest rate.
I'm right there with you. I'm right there with you.
Holy
So,
cow.
so one of the things that we skipped over a little bit is the different types of loans that you offer. So, they're pretty common to us in the industry. The FHA, conventional VA. Are those your big three, or are there any other type of loans that you offer or recommend to? And I'm sure it probably depends on the kind of buyer. Obviously, you're first time. Let's talk about first time buyers for a minute. So, if you're a first time buyer, what's the, I don't want to say the best loan product, because obviously that depends on the individual, but what products do you recommend?
If you're a first-time buyer, most likely, unless you're a veteran, because there are first-time buyer veterans out there, and if you're a veteran, take advantage of your benefits. The VA loan is hands down one of the best products out there. As far as qualifying for it, as far as the rates, the fees, the fact that it's 100% financing. So if you're a veteran, thank you for your service and take advantage of that loan program. If you're a first-time home buyer that's not a veteran, the two big ones that you're going to probably fall under is going to be the FHA and conventional. And I would say first-time home buyers typically go more for the FHA. And the reason for that, FHA is a little bit more lenient on requirements for qualifying, a little bit more lenient on the credit scores. It's 3.5% down. So, and the FHA couples with just about almost all down payment assistance type programs. So if you're searching for like the 10,000 in bond loans, or if you're searching for some grants, FHA is pretty much the product that couples with everything. Conventional is 3% down, but it's not as forgiving when it comes to qualifying. There's a hard and fast stop at a 50% debt ratio. FHA, you can go to 55, even 60, depending on your circumstances.
Mm-hmm.
Conventional is going to be a little bit tougher as far as qualifying for it. Um, and it's also, as far as the rates and points, it's a little bit tougher on the conventional side of things as well. So you're going to probably go into one of those two programs. Now, if you're looking to buy in rural areas, then you have a third option, which is called the USDA loan, which is also 100% financing, but it has to be a rural area. So let's say I'm in Jacksonville, Duval County, the entire Duval County is not eligible for USDA. But if I want to go to, say, an outside city like McClenny or, south of Middleburg, and if you don't know what I'm talking about, it's just, look at your city and look at small towns around you. Those would qualify more for your USDA. Also a great program. You just, since I'm in Jacksonville, I don't see as many because most people are buying in the city limits. But I would say those are going to be your top two programs. Now, what we can do as far as loans, it's probably better for me to say what we can't do. So the only two loans we don't do is new construction and lot loans or land loans. And then when I say new construction, that means you've got a lot that you want to erect a house on,
Yeah.
and you got to find financing for that, what they call interim period of building. If it's new construction, like you're buying from a big box builder like Lennar or Horton or something of that nature, we can absolutely do those. It's
Mm-hmm.
just your, custom build, find a piece of land and build a home. We don't do those. So if you're looking for, FHA, jumbo, we got some specialty programs. Like if you're self-employed and don't like to pay too much in taxes each year, then we've got some bank statement programs. We've got some DSCR loans where you're, investors who want to qualify based on the cash flow of the property. We do renovation loans, and we do renovation loans under VA, FHA, and conventional. And that's if you find a home that maybe needs some TLC. Maybe you want to do an addition on it. Maybe you want to even add a pool. All those type of things, you can kind of wrap those in with a renovation loan, like doing your upgrades on top of purchasing that property. So it's financed in versus buying the house and spending the 20 to 30, 80, whatever it's going to cost to do those renovations. So you do have there's a product for everybody. It's just a matter of what is your specific need and where you're at in the stage of your home buying process.
Nice,
Let me
nice.
ask a
I'm
follow up on
actually,
that.
yeah.
Let me jump in real quick here. The DSCR loans. I mean, what percentage of buyers are you seeing, especially in a market climate like this, might want to utilize something that doesn't take into consideration their personal W-2s or their credit scores? I mean, are you seeing people use this product more, especially in this climate?
Oh, 100%. It's an extremely popular program. And I will say it's if you're new to the investing world, you're probably not going to go with this program because the rates are a little bit higher, and the costs are a little bit higher for this program. And you're a W-2 employee, you're buying your first investment property. You're not going to you're going to be squeaky clean to go through the conventional process. Where this comes into play is your seasoned investor who knows his cash flow, knows his market. Um, is willing to pay the higher interest rate for the ease, because we verify no income whatsoever, not even employment. The only thing we verify is that you have the money to put down and that the property cash flows. And what I mean by cash flow, let's say you're renting it for $2,000 a month, that property's got to at least bring in $1,500 a month, and then you qualify. If you bring in, and the rates are going to be varied based on what the income of the property is. So if you're bringing in 1,500 and your payment's 2,000, rates a little bit higher. You're bringing in 2,500 and your payment's 2,000, rates a little bit lower. But it's an extremely popular program, especially the seasoned guys that have 20 properties. They don't have to go through and give you a lease and tax returns and the tax bill and homeowners insurance and HOA bills and all that stuff for every property they own. This is their ball game, and so they look for properties that cash flow with higher rates, because that's what they want to do. They want to do the DSCR loan and close in 15, 20 days and be done with it.
I think you just picked up a customer. I can see Trevin's wheels turning. He's going to be calling you when we get off this podcast. So interesting. You mentioned McClenny. I'm actually from McClenny. Grew up out there, so I love Baker County. Go Wildcats. Yeah, definitely the USDA is something. So quick question. You mentioned new construction. So one of the things that we compete with new construction, or that mortgage companies compete with, is that when you go into a builder that's offering incentives, a lot of times those incentives are actually tied to that new construction. In other words, you have to use that mortgage company to get those closing costs and things like that. How do you compete with that? I mean, are you able to compete with that type of program, to where you say, hey, I want to use my guy Eddie over here. I don't want to go through that builder, but a lot of times, again, they're forced to, because of that incentive.
It is just the business we're in. Those won't stay there forever. But right now, as they have those incentives, for a guy like me, it's near impossible to compete with them. The only time I can do a builder loan, when these big box builders offering the lower rates and so forth, the only time I can actually do a loan for them is if they denied that client, or they don't have an avenue for that client, then I can do the loan and help them out. Which, believe it or not, happens quite often, because the guys that I don't want to say anything bad about them, but, sometimes they don't have the experience, to engineer
Sure.
an approval,
Yeah.
and what I mean by engineer approval is that, I'll give you an example. A customer was wanting to buy a house, and they're putting like literally 40% down. And I had to builder deny them because of a high debt ratio, and they were moving here. So one had a transfer job, the other one was going to get a job here, but didn't have the job yet. So it's just one income, and they denied them for this. And so I got a hold of it, and I was like, okay, here's what we're going to do. We're going to put 5% down. I'm going to pay off all your debt. Is 10% down, actually. I'm going to pay off all your debt. You qualify for that home. You're good to go. Just don't tell the builder what I did for you. So don't give them any ideas. And we end up doing that deal. So it depends. When you have situations like that, yes, I do get a trickle of buyers that come in when they need some help. But builders, right now, it's very tough to compete with. They are giving some crazy incentives. I hate saying it, because, obviously I want to do the mortgages too, but I'm also for the client. I'm also for the market. I want to see a healthy market. I want to see people buy houses. And I will tell you, the builders are right now just giving crazy deals. It's Black Friday every day with the builders these days.
It would be interesting to kind of do a deeper dive into those numbers, like you mentioned before, that a lot of times it looks better, but maybe it's not. Maybe you're paying for that in the course of the loan, because a lot of times I think what happens is they say, okay, we're going to give $10,000-$15,000 credit if you use this mortgage company, and automatically that's the selling point. So they're driven to that. And it doesn't matter what the loan looks like. They're just going to go ahead and take that, because they get those closing costs paid, and it's liquid funds that they don't have to come up with. But maybe long term, it's not the best loan, possibly.
Yeah, you know what? Absolutely right. And I'll take a step back. If you're going to use the big guys, the brand name household names that are in every state in the U.S., their deals are really good. If you're going to use the small builder that maybe does 50, 100 houses a year, that's more regional,
Sure.
to the area, and they don't have the pockets to give the incentives like the big guys do, then yes, their preferred lender I can sometimes compete with. And I do get an estimate, and I'm honest with them. If they send it over to me, I'm like, hey, look, what you got with this builder is great. Just continue with them. I'm not going to be able to get you something better. But it doesn't happen often, but every once in a while I can compete with the smaller guys.
Yeah. Yeah. So if you could give advice to a buyer that's out there that's looking to go ahead and start that process, what's the biggest factor for them as far as what they need to what they need to do during that process to be successful? A lot of times, obviously, it's dependent upon income, credit, those sort of things. But do you ever get into any scenarios to where there's not full disclosure until you get further on in that process, or what? Just kind of give, I guess, just a couple tips for buyers that are coming in to make that process as easy as possible.
Sure. So, the one thing I want to tell folks is that, real estate is a long-term investment. And I want to preface this because people see home prices where they're at today. And some people remember what happened in 2008. And they're sitting on the sidelines going, I'm just going to wait for home prices to drop. If you need a house, start now. The equity is built over time. You're not going to build equity in a property in 1 year, typically not. The equity is built over time. Your wealth building power is generated by time in the real estate. It's okay if you bought a house today and we see a correction tomorrow. You keep making your mortgage payment, nothing happens. They're not going to come take your house. You still have the lender if you look at it this way, the lender is more on the hook than you are if the house property drops, because typically you're not putting as much down as what the lender has in the property. Over time, you're going to benefit. You also benefit from a fixed costs, your fixed housing costs. Where rents continue to increase, you're going to go ahead and starve that off by purchasing that home. Every person, I will tell you this, is that if you look on, real estate was tracked for 81 years. 81 years. Real estate increased in value 75 of those 81 years. We had the 3 years back in 08 to 10 where they dropped, and there's a couple years prior to that, but real estate has won 75 out of 81 years. That's 90%. Like, what other investment do you know that you win 90% of the time? When you want to buy a house, when the best time to do it is now. When you are ready. If you need a house, buy it. Don't worry about the rates. Don't worry about the prices. Rates, you can change when they drop. You can change terms. You can adjust that with the refinance. Prices are going to continue to go up. Next 10, 20, 30 years, you're going to have a nest egg. You're going to have wealth. When you're ready to get started, or you're thinking about getting started, the first step is the pre-approval. I can't stress how important that part is before you even pull up Zillow and start looking at homes that you want to go see. Is you want to get the pre-approval. That pre-approval is key to determining what that budget and what that price of that home that you're going to shop for. It's also the key to make sure that you are in a financial position to purchase a home. Buying a home just isn't about the payment. It's about the investment piece of it, where you're going to buy that home, what area of town, what the resale is going to be. I mean, you guys are thinking when you show homes, you're showing a home to a client. You're not just thinking about their home for the day, but you're thinking about, hey, when you go to sell this property, are you going to have trouble selling this property? So, that's what we're doing too. We're just doing it from a mortgage standpoint. But the pre-approval is the first step. It does not cost you a dime. You do it for free. There is a credit check. And we can do a soft pull, but I tell folks the soft pull is not the way to go. You want to do the hard pull, because the hard pull and soft pull does show different things. And it also, with a hard pull, we get to run scenarios like through a system. If there's anything like you need to do to correct your credit scores, we need that hard pull to be able to do it. So it's a hard pull on the credit report, doesn't cost you a dime, and you get free advice. And then, you get a guy like me that answers questions until you pull that trigger.
Trevin,
That's all.
give him a microphone so he can drop it, would you?
There you go. Just
There
drop
you
that.
go.
So,
No, that's
hey
awesome.
Eddie,
Eh,
it's been great. Trevin, you wanna close us out here?
Well, I'd actually like to drop another question his way.
Sure.
Yeah.
Okay. No, this is a valuable time, and we appreciate it, Eddie. Given the latest changes in the National Association of Realtors lawsuit and how everything changed for buyer brokers agreements going forward, you know, agents have to now, all agents, right? Not just listing agents, which Dave and I focus more on, but buyer agents have to now potentially convince their buyers that they may be on the hook for commission. So from your perspective, how are you dealing with that? Because I'm sure the numbers are tight, on affordability, and are you getting into that conversation with buyers? Like, are agents doing a good enough job to explain that, or are you finding yourself jumping in the mix?
You know, that's a great question. And then a lot has changed from that August ruling or rollout. I don't get into conversations about commissions up front. I'll let you guys do that and determine, what you're going to charge that client. I get into the conversation once we're putting together a deal based on what's available to be paid by the seller, if that makes sense. So I'll give an example. Let's say if, average commission from a buy side is say 3%. And 2.5 to 3%, on average. And let's say they're negotiating an offer, and that seller or that seller's agent is paying no more than 2%. Then yes, we have that conversation of, well, that additional half 1%, this is what it's going to cost you. This is what your closing costs are going to look like. Maybe they put a little bit less down if they have the ability to in the mortgage loan. So I work with the agent once they're actually structuring an offer with that property. I'll be honest with you, I've had a couple that just wanted to pay the buyer's agent's fee out of pocket because they just wanted a lower price for the house, and they wanted a lower loan. They didn't want to include a loan amount. So they're like, oh, yeah, they're putting it. Obviously, they're putting a good big chunk down. It wasn't like they were doing minimum down payment, but I've had a few to say, you know what, I'm paying that in cash, and this is what I want the price of the house to be, and we worked it out that way. So it's really not for me to discuss the commissions with the client up front when I'm doing a pre-approval. I'll let you guys do that, and then once we need to have a conversation to structure a deal correctly, then we'll all talk about it together, and that's what we'll discuss with the client. Hey, this is what it looks like if we do this way or so forth. And I've had a few clients too that they want to go in and they want to offer lower on the home, which is fine. But when they do that, there's got to the net for that seller is still got to be there. And so, they may come back and say, well, we're not going to pay this, we're not going to pay that. And it's just a matter of showing them like, hey, if you just bump up your price 10,000, cover all this stuff so you don't have to bring it out of pocket, it's $60 a month in your payment. And once they hear that, they're like, oh, sure, yeah, I could afford an extra $60. Yeah, and I don't have to bring 10 grand. Let's do it. So it's everyone's different. There's no one size fits all when it comes to this kind of conversation.
That's cool. That's cool. Well, no, hey, Eddie, we really appreciate your time. You provided us a lot of valuable insight from your perspective. Dave and I talk about this like we're blue in the face on these podcasts, but it's so invaluable and precious to get someone who's in the field, in the trenches, talking about it directly from their viewpoint and standards. So, we thank you for your time. And with that said, we're putting the checkbox on episode 17. So thank you everybody for watching.
Right.
We hope you subscribe. We hope you reach out to Eddie directly on social media. And Eddie, before we go, what's your handle on Instagram?
If you look at Eddie O'Keefe, you're gonna find me on Instagram, Facebook, LinkedIn, TikTok. So,
Look at that. So that's fantastic. Hey, reach out to Eddie, say hello, and thank you guys for your time today.
all right, thank you guys.
Yeah. Thanks.